Recently, I was meeting with a younger client. They have an expanding family, dual incomes, and they're kind of growing out of their home. And so they were asking me what they should do with buying a new house and what a mortgage looked like and how it impacted their financial situation. And so I thought I'd do a video on mortgages and looking at a real life example of a mortgage that was set up several years ago and understanding kind of the interest and general concepts around it. And so that's what we will be discussing today. So, what is a mortgage? Really, a mortgage is a loan that you take from someone else, typically a bank, and oftentimes in a mortgage situation, you'll use the house as collateral for that loan, meaning that if the if you default or you don't make payments on that loan, then the company who lent you the money can come after your property. There's really two types of loans. There are loans that are secured by, say, a home or a car, meaning again that if you don't make your payments, then the person who lent you the money or the company can come after you. Or there's an unsecured loan, like a student loan or a credit card, meaning that the money's been spent, they can come after you for it, but there's nothing that's securing that loan for them. Home mortgages is a type of secured loan using your house as collateral. How do you feel about debt? A lot of people ask me, is debt bad? And it really depends on what type of debt it is. And anytime you're buying something you can't afford at the moment, it seems like something that you should weigh in and consider. Whether it makes sense for you or not. I think there are certain things that can make sense to go into debt for, like a home, oftentimes education and getting student loans can make sense. Sometimes a car, again, it depends. There are certain things that personally I wouldn't feel comfortable going into debt for, things that really increased lifestyle or hobbies. Getting a boat, I wouldn't feel comfortable going into debt for getting a boat. Other people do, and that's okay. So it really just depends on what you value and what your situation is and what you're willing to pay for later compared to paying for now. A lot of people talk about debt with these concepts of like front-loaded interest. And here's an interesting fact. In a typical 30-year mortgage, you'll pay more in interest in the first decade than you will in the next 2 decades combined. And so let's take a look at a mortgage that's been in play for a few years. It started back in 2020. And so the interest rates were much lower in 2020 than they are currently. Interest rates are probably more than double what they were in 2020. For home mortgages. So in this particular loan, the original loan amount was $357,000. It was for 360 months or a 30-year typical mortgage. It again started in April 2020 with a 3% interest rate. And the monthly principal and interest payment was $1,508.76. And if we take a look over time, the first decade, $95,000 of the payments would go simply to the interest. None of that that particular amount was towards the principal. The greater amount was for the principal. But if you take a look at the second and third decades, then the total amount spent in interest was less than what was spent in the first decade. So interest, when we talk about interest being front-loaded, it means that more of that interest is being paid earlier in the loan rather than later in the loan. And so let's dive a little bit deeper into that monthly principal and interest payment and talk about how those are made up and how you can calculate your interest based off of your own mortgage. So calculating interest is really simple. You don't need any fancy equations, just some multiplication and division, addition and subtraction is really all you need to calculate what the interest portion of your payment looks like. So the equation for that is if you take the loan balance, how much you owe on the loan, multiply that times your interest rate, and then divide it by 12 months. That equals your interest expense. So again, in this particular situation, we're looking at a $357,000 loan times your interest rate of 3% divided by 12 months. That means that of the roughly $1,500 payment that we looked at, in that first month, $894 of that is going to interest, with the rest of it going towards principal, or the amount that's paying down the loan. If we want to know how much went to principal of the $1,500, $894 went to interest, then we can do, again, some simple math to figure out that $614 went towards principal to pay down the loan. So a lot of times we'll use the words principal and loan balance interchangeably, and so just kind of know as you're looking at your mortgage statement that those things can be interchangeable. So now we get the new current principal balance after the first monthly payment, which was the $357,862 minus the principal you paid off of $614, and now the new loan balance is $357,247. In mortgages, you have your principal and your interest, sometimes abbreviated as PI. You also have additional expenses such as taxes and insurance, or sometimes you'll hear the phrase PITI. Again, it stands for principal, interest, taxes, and insurance. Taxes and insurance can sometimes be called escrow, and so again, those two terms are used interchangeably. Essentially, what happens is to the mortgage company, you make monthly estimated payments for taxes and insurance, and they'll just save those in an escrow account and pay those out once or twice a year to the insurance company or to the state for your property taxes. Now, there can be an additional insurance expense called primary mortgage insurance, or PMI, and that usually gets tacked on if you've borrowed more than 80% of the value of your house. And so that can be an extra expense. Watch out for that. Again, sometimes it can make sense, sometimes it doesn't. So just be aware of that. So here's a real life statement. Now this is 5 years later after the mortgage started. Now we're in 2025. And we can see some of the details here. This outstanding principal balance now is paid down to $292,000. We still have a payment of about $1,500 of principal and interest. Now we can see that $778 went to principal, $730 went to interest, and then about $560 went towards the escrow, or taxes and insurance. So the total principal, interest, taxes, and insurance payment is $2,069.05. Now again, the only thing that's going to change that outstanding principal balance is for the next month is this principal number right here, that's 778. Your loan amount is going to be reduced by that much. Then your your interest is going to be recalculated based on multiplying your interest rate times your new principal balance divided by 12. And that'll help you understand how much of that monthly payment is going towards interest, which then you can use to calculate how much of the monthly payment is going towards principal. Now, there's an extra payment being made on this mortgage each month. You see this little term down here called curtailment. And this curtailment, or reduction of $400, means an extra $400 was paid during the month on top of what needed to be paid. So instead of $2,069 being paid, it was actually $2,469 being paid. And any extra payments that go to the mortgage statement go directly, not to the statement, but to the mortgage payment, go directly to the principal. So instead of $778 of principal being paid down, it was actually $1,178 of principal being paid down, which again pays down the principal faster and then will reduce the amount of interest that is owed in the next month. So if we take a look at a compounding effect of what does an extra $400 a month of payments do to this particular loan, we can see that the total interest expense changes from $185,291.83, it got cut off there, to about $125,000. So by paying an extra $400 a month, we can save about $60,000 of interest payments, of interest expense over the course of that loan. And the monthly payments reduces from a 30-year payments of each month, so $360 of total monthly payments, down to just over 2 years, or just over 20 years at 254 monthly payments. So by paying that extra $400 a month, you drastically reduce the amount of interest expense you have and drastically reduce the amount of time you have to be making that mortgage payment. So a lot of times people ask, how much mortgage can I afford? And it's a good question to look at. A lot of times companies will use a 28 or 36 figure. So 28% of your monthly income can go towards the mortgage, but not more than 36% of your income total can go towards debt. So for example, if you have a large car payment or large credit card payments, that may reduce the amount of your income that can go towards your mortgage to less than 28% if the total amount of debt is going to be more than 36%. And so those are the numbers that you'll receive from as you go to look at mortgages. Obviously, there's a lot of different types of mortgages, there's different types of programs, but that's kind of a good rule of thumb to think about. But a lot of times what we advise our clients is not necessarily how much can I afford, but what total monthly payment, including principal, interest, taxes, and insurance, am I willing to allocate for my home so that I can also have enough money to do other things that are important to me. You guys, may have heard the term being house poor. It means that you put so much of your money, so many of your resources into your home that you feel like you really can't do anything else. And from a happiness factor, that can really have an effect. And particularly if you buy into a neighborhood that is, as expensive as you can get and as much as you can afford, that might actually have a negative impact on your happiness. Because sometimes as we take a look at happiness, it's relative. What we have and how rich we feel is relative compared to our peers or the neighborhood that we're living in. There's been a few studies done that I think are really critical and important in this situation, knowing that happiness can actually come from a smaller home than what you could technically afford. And so from a Clark and Oswald study that was done back in '96, talk about human beings care about their relative position in society. Higher income improves well-being, but only in relation to others. It's not so much what you earn that makes you happy, but how your income compares to that of your peers. And again, not that we should go out and comparing ourselves all the time, but it does have an effect on our happiness. We do need to be aware of it. Another paraphrasing from the Easterlin paradox: people don't just care about how much money they have, they care about how much money they have relative to others. A person can feel poor if their neighbors are richer, even if they themselves are objectively well off. So again, as you're looking at making this home purchase and deciding, trying to figure out how much you can afford, think about the other things that you want to be doing, how it compares to the other neighbors, and if everyone else is going on vacations and trips, but you can't take your kids anywhere because you can't afford to, because all the money's going towards the house, then again, that can have an effect on the happiness of yourselves and as well as your family. And then finally, from a study done in 2012, living in a richer neighborhood while controlling for one's own income is associated with lower life satisfaction, suggesting that local social comparisons matter for well-being. So keep in mind all these things as you're factoring in and making decisions based on your values of what you choose to afford, not necessarily what the maximum amount the mortgage company can provide to you. So thanks. I hope this video was helpful in helping you read your mortgage statement. We'll be coming out with some more videos. If you have ideas or things that you want us to share, please link that in the comments and we'll try to get those videos out.